Any framework around that right yet?
Tokenization, I think, is very important to put things on chain. I think is a huge potential innovation that, if it spreads to in the securities industry, I think it can help maintain integrity. It can help make things more efficient. It can lower costs, maybe, and then have the ultimate would be to have on-chain clearance and settlement of securities, and that would really de-risk and make safer our markets overall.
Most Americans, Brits and Europeans and everyone else for that matter don't really understand how old our financial system really is. Not old like old fax machines old, or not old like dial-up, but old. And that matters because while your rent, your groceries have all exploded in price, we're still running on a legacy system that moves trillions of dollars. That disconnect is not an accident. And this week, something quietly changed that should make everyone stop and actually pay attention. Because behind the closed doors, the Trump administration just authorized the single biggest structural rewrite of the United States financial system in history. Not a headline bailout, not another stimulus check, no, not a rate cut, it's a complete rewiring. This is the part that no one else is really talking about. Let me give you a number. $3.7 quadrillion. Nope, that's not a typo. I didn't misspeak. That's how much value flows through one institution every single year, quietly, invisibly, without your consent, your awareness, or even your vote. And that institution just got permission to move the entire system onto a new digital backbone. If that number sounds absurd, yeah, it should. Quadrillion comes after a trillion, and trillions already broke most people's intuition years ago. This is not about crypto hype. This is not about the future of finance marketing slogans. This is about control, surveillance, and who the system is designed to protect when things actually break. And history always says it's never the average person. So who actually runs the system? Every time you buy a stock, every time you sell a bond, every time a pension fund reallocates, every time a hedge fund moves in size, you think that transaction is simple. It's really not. It goes through brokers, it goes through intermediaries, it goes through clearing firms, then custodians, and then finally one centralized entity that keeps the master ledger of who owns what. That entity is the DTCC, the Depository Trust Clearing Corporation. If the financial system were a city, this isn't the mayor. If the water pipes, sewage, power grid and roads, it's all of that all rolled into one. And it clears and settles nearly every single security transaction in the United States of America. Now, let's take a walk down memory lane. When the system froze in 2008 in the GFC, this is one of the pipes that nearly cracked. When markets seized in 2020 March, this is where the pressure point was. And every time the Fed steps in, it's to protect this layer. This is a quick history lesson we'll go through. In the early 1970s, the US quietly broke the gold standard. No public vote, no referendum, just one arbitrary decision. The system worked better afterward. Yeah, for governments and for markets. But wages, they stagnated. They still are. Inflation surged. It still is. And asset owners quietly pulled away from everyone else. Shock horror, they still are. Does it sound familiar to you yet? Every major financial upgrade in our history has always been sold as efficiency gains. Everyone has distributed power upward and from below. This is no different. So Securities and Exchange Commission just issued something that's called a no action letter. Now bear with me, that sounds boring, but it really isn't. A no action letter means one thing. We see what you're doing, we are aware of the risks, and we're not going to stop you. The DTCC just got that letter, specifically for tokenizing of securities. What does that mean? It means stocks, bonds, currencies, all of these assets can now be legally tokenized. I'm talking treasuries, derivatives, everything, all moving onto blockchain-based rails, going live as early as February. This is no longer experimental. This is not even a pilot. This is explicit written permission. So why is all of this happening now? Well, ask yourself something really honestly. Why do governments suddenly care about the efficiency after everything they've printed? After all of the trillions that's gone into the system in terms of liquidity? Why do they want transparency after inflation has gutted our purchasing power and has made your wages stagnate? Because the old system is doing one thing. It's breaking under its own weight. because since 2008, the Fed's balance sheet exploded from under 1 trillion to nearly 9 trillion. Quantitative easing became permanent. Emergency measures became completely normalized. And every time markets now wobble, the answer is always the same. More liquidity, more stimulus, more of that methadone, more of that monetary morphine, more support, more intervention. But the plumbing was never built for this scale of intervention. So instead of shrinking the system, they are now upgrading it. Not for you, not for the survival, but for some other reason completely. This is where the sales pitch of the government's tokenization scheme comes in. Because tokenization sounds clean, right? It sounds transparent, efficient, transparent, instant settlement, no middlemen, no intermediaries. And yes, part of that is definitely true. But every technological leap in finance always has two sides. The same system that allows instant settlement also allows a few other skullduggeries. Instant freezing, instant tracking, instant enforcement. This isn't speculation because public blockchains are more transparent than any other system built in history, which is why the whole blockchain layer was always so paradoxical for me, because ironically, it actually issues more control than actually liberating people, because every transaction, every movement, every wallet, recorded everywhere and anywhere forever. So let's look at a warning from history. In the 1930s, during the Great Depression, the US government banned private gold ownership, not because gold was dangerous inherently, but because control was slipping. When systems come under stress, governments don't loosen their grips, they tighten it ever more. Technology doesn't change that instinct. It actually amplifies it and makes it far more efficient. And you know who else loves this? The elites. Here's why. I'm not talking about some amorphous, unidentifiable, anonymous group of people. I'm talking about tech elites. Tech elites love tokenization because it unlocks new asset classes. It fractionalizes ownership. It creates programmable finance. Bankers, they love it because the settlement risk completely disappears between counterparties. Leverage becomes even safer for them, which means they can make even more money and then get bailed out expeditiously, no doubt. Politicians also love this because enforcement becomes automated, compliance is innately embedded, and dissent becomes ever more trackable. Anyone who is dissenting from the system can be frozen out, tracked down, isolated, and identified. So ask yourself, who does this actually help? It's not renters, it's not wage earners, it's not people living paycheck to paycheck while CPI says inflation is cooling. The bedrock of all of this skullduggery is the CPI lie. We're told constantly that inflation is down, but food is still up double digits till 2020. Rent is structurally higher, energy remains volatile, wages still lag, consumer sentiment is near historic lows, unemployment is creeping up, and people are finding life harder and harder and harder. And yet what? Markets are still sitting at all-time highs, making all-time highs almost every single day. Why? Because liquidity always flows to assets, never to people. And tokenization won't ever change that. It just accelerates that trend. Now, this is the part I'm not entirely certain about. I want to actually be honest here. I don't know how this exactly plays out. No one does. Anyone who tells you they know how is a charlatan. This could increase efficiency. It could reduce systemic risk. It could democratize access. Or it could do something entirely different. Flip side, it could definitely harden financial surveillance. It could entrench asset inequality. It could increase the wealth gap. It could make opting out of the system entirely impossible. And history actually says both of those things can be possible and true at the same time. So what should we watch going forward? You need to watch treasury tokenization, interoperability layers. Who controls the rails? Which companies are they? Who are their vested interests? Who do they donate to in their political dispositions? We need to watch how quickly emergency powers actually become permanent, because there's nothing more permanent in finance and financial markets than a temporary measure. We need to also watch how optional clocking in and checking in actually becomes. What is the compliance like? Because it always comes down to actually the permissions. So the final thought, every reset is always sold as progress. Every reset reshuffles power from the bottom up to the top, and it centralizes it. This one is bigger than rate cuts. It's bigger than elections. It's bigger than narratives, because it's actually structural. And structural changes don't care how hard you or your wife or your kids or your family works, only where you sit in the system. Now, I could be wrong. I mean, I hope I'm wrong, but history hasn't been kind to people who assume financial upgrades are always neutral. Let me know what you think I've missed, what I've overstated, what I've got wrong, or where you think I'm completely off base, because I'm here to talk about money, liquidity, and markets, and the machinery behind them all. And as always, guys, this isn't financial advice. I'm just one guy trying to read the system before it reads us. So with that note, ciao for now.